Major changes post the recent budget. A bill setting up a new development finance institution has just been cleared by the cabinet. Second, work on a new asset reconstruction company or a new version of a bad bank is progressing, with the government agreeing to guarantee the security receipts that will be issued by this ARC when it is set up. And third, privatization of PSU banks is on the anvil. To discuss how all these may pan out and how they should pan out, I have with me some of the best veterans from the industry. Rajneesh Kumar, former chairman of State Bank of India; S.S. Mundra, former deputy governor of RBI and a commercial banker for 4 decades; and Mr. Anand Sinha, also former RBI deputy governor, who has made rules for this sector for a very long time. Gentlemen, thank you very much indeed for joining us. Well, let me start with you, Mr. Rajneesh Kumar. What we know about the DFI so far is that its governance looks different from what the previous DFIs were. It is likely to be private sector emoluments and an independent board, 50% of the members. Do you think this setup gives you a feeling it will be an improvement over the previous avatar?
Yes, for any institution to be successful, it's very important that what is the quality of the people who manage it, whether it is at board level or at KMP level. And if you want to attract talent, there is no way but the compensation structure and the freedom to hire the best talent. If that is available, only then an institution can be successfully built. And we are again making a beginning after so many failed experiments as far as the DFI is concerned. So I hope that this time the government will get it right and will have the necessary freedom for this institution to tap the best available talent in the country, or even if it is available overseas. But there is we can't waste another opportunity, and it has to be ensured that this institution, which has been set up with a lot of hopes, is successful.
Well, Mr. Mundra, what else should the government do? The former DFIs had a sources of funding problem. How will that be resolved this time around?
Thanks, Lata. To my mind, of course, you started with the point of governance and the structure of the company. That is, of course, important. But I think there are a number of requirements which would be important. So let me quickly, as an opening comment, deal with them. Number one, as you said, see, DFI of past and DFI which is being envisaged today, they have to be looked quite differently. Number one, DFIs are in their erstwhile avatar. Mostly infrastructure was not a sector as we know it today at that point of time. They were basically engaged in, financing the manufacturing projects, etc., of the short-term gestation. I don't think today you need a DFI for the usual manufacturing projects or the expansion of the short gestation. I think there are other institutions and market has evolved to take care of that. So let us be very clear that number one, this DFI has to be completely infra-focused of the long gestation period. That's the one thing. But second, learning from all the past experiences, this institution has to be an anchor institution, as an anchor lender. Not, some of the DFIs in various versions have been set up in recent past, but they have ended up become one of the small lenders along with a number of lenders. I don't think that brings that kind of focus. So they have to be anchor lender. They need to have the expertise in-house as well as in their ecosystem where they can draw on the expertise. They should also have a say in the policy formulation. They should be a part of that discussion. And as I said, they should have a connect with the entire ecosystem around the infra financing. That is one thing. The second important point is how the regulation would be covering this DFI. If they are to be regulated like any other NBFC or any institution, I think there would be problems around that. If we have learned from the past experiences, despite all the best intention, these kind of projects would have their own set of problems which will keep on coming. Maybe it from the policy side, maybe it from the clearances side, maybe some development in the country where the cash flows are affected. So whether there would be some leeway available to them where in the life of a project, some dispensation can be considered for them. That would again be crucial if we are drawing the right lesson from the past.
Okay.
And as you mentioned, liability profile will be very, very important. I think the problem of the erstwhile DFI was their liability profile.
Yes.
So they must have, and for that, I think they should be able to, if we talk about within country, the pension fund, the insurance companies, etc., who can provide the patient long-term capital, it will be very important that they come into the market in addition to sourcing it from the internationally. And finally, Lata, I would just like to say that our tendency to marry an asset is something which needs to change in this country now. So this DFI should be able to crystallize a originate and distribute model, so that you take the execution risk when the cash flows are visible. There are several players where you are in a position to distribute, and they vacant their book and keep on doing the more underwriting. I think this is a kind of whole structure which needs to come into place.
Well, the InvITs have started, so hopefully, they will be able to circulate their assets quickly using InvITs.
So.
Yeah, at least some beginning has been made.
Yeah.
But Mr. Sinha, Mr. Mundra is asking for something very big. Can regulatory dispensation be given at all? I would assume he means that if projects are not started on time, they are given more leeway. But your thoughts on how best to construct this?
See, the importance of DFI is financing in the construction phase, in the project execution phase, because that is the phase where there are a lot of uncertainties and a lot of risks. And after the cash flows stabilize, then you can have syndication, you can distribute it to various investors or even to the banks. So when you are in the execution phase, certainly regulatory dispensation would be required. And I would add that even today, there is a lot of regulatory accumulation in that phase, because after the NPA rules have been tightened considerably, you will find that the dispensation which is available in the before the commencement of commercial operation, a lot of leeway was available earlier, and that continues. Now, one can have a look at that and see whether something more is needed. But yes, one has to recognize the different nature of risks in the execution phase, and regulation will have to take care of that.
Mr. Kumar, my sense is that there is a mistaken belief that because for the bullet train, you could get the Japanese International Cooperation Authority, the JICA, to give a 50-year loan at 0.1%. People are of the opinion that this development finance institution can raise funds globally cheaply from, sovereign wealth funds or such organizations. Is that really possible?
We cannot compare like the two situations. Japanese, they have a lot of money. They are not short of capital. The interest rates are negative. Inflation is, I think, close to zero in Japan. So whenever we are talking about the interest rates, and if we are talking in terms of the local currency, then we have to talk about the real interest rate, and we have to account for the inflation. If country has 5% inflation, obviously you can't fund a project at 1% or 0.5%. And
Mr. Kumar, my pointed question is that these kinds of aids are given by organizations like JICA, tied to us buying their, bullet train coaches or something like that. Because it is available for a particular project, can we assume we will get very good international funds for a DFI?
No, everything like whenever you raise any funding, any lender, the first principle is about the risk and the reward metrics. So it all depends upon the rating of the project or the institution itself, because it is a 100% owned by Government of India. So recently, whatever is the borrowing for a sovereign, so obviously for DFI, it cannot be lower than the sovereign. So that is what we have to recognize this fact.
He is going to be 7% at least.
Full details are not available, but through.
Okay, got that. What's your sense, Mr. Mundra? You think international money will be available? I mean, all sovereigns are indebted, and how at this point in time? Look at the US fiscal deficit, almost 25%. So do you think we will get global money?
Two things, Lata. Number one, you won't always get the 50-year money at 0.1%. That, as Rajneesh was also mentioning, that's an entirely different kind of thing. So you don't get that kind of money. But having said that, globe is neatly divided between the haves and have-nots, as you are mentioning. Not that all are heavily indebted. There are sovereigns, there are funds which have huge liquidity available, and they are in search for yield, they are in search for the good credit. So I think it's not to say that there is no sourcing available in the market, but yes, what will be important, and that is where I think what government has indicated in the initial phases, if there is a kind of sovereign support is available, and once there is a journey, there is a passage of this organization, then you have the past history available, ratings can reflect that. At that point of time, even their ability to source is independently of the sovereign support would also increase. So I would say there are good possibilities to get the international funding. Yes, 50-year and 0.1 is clearly not something which can be used as a benchmark.
Okay, got that. Well, Mr. Sinha, a final word on this issue of DFIs. From what the finance minister said in the budget and in allied speeches, it looks like the board of this new DFI, proposed DFI, will look at taking over the activities of IIFCL or merging with it. That is a sensible thing to do, you think? You have a market-driven management in the new DFI, and it takes on the experience of IIFCL. Is that a good way to go?
See, the point is that the new institution would be set up, as per the announcements, on a different footing altogether. Now, the board will have to decide whether there is good synergy in having IIFCL or other institutions which are there. Any merger is actually quite problematic. It's not an easy journey. So one will have to take a decision on that. But I would certainly say that scaling up through mergers, instead of having a bigger number of financial institutions getting into infrastructure financing, would certainly be preferable. But ultimately, it has got to be decided based on the synergies, based on how the board looks at, and it should not become an article that this must necessarily be done.
Okay. Got that, sir. Well, we have to take a break. I want your word also on the new proposed asset reconstruction company, or bad bank. We are back in a minute. Saying the Indian banking sector is on the cusp of some major policy changes. Not only is the development financial institution about to be set up, a new one with probably good learnings from the past, an ARC is going to be set up for the first time, an asset reconstruction company. It's just jargon for an entity which will take over default loans, bad loans, and try and resolve them quickly. Mr. Rajneesh Kumar, former chairman of SBI, and two former Reserve Bank deputy governors, S.S. Mundra and Anand Sinha, are with us. Mr. Rajneesh Kumar, you had already mooted this idea when you were at SBI and as part of Indian Banks Association. Now the government seems to have given its approval to guaranteeing the security receipts of the ARC when it is created. You think we are well on the way to now cracking this issue?
Yes, I think there's a lot of work which is going on. That's what I understand. And IB is very actively involved. Department of Financial Services is very actively involved. And this is part of the budget announcement. So I think the idea to set it up as quickly as possible, there seems to be good progress, and it will become a reality.
Get the feeling that assets will be resolved quickly because they are aggregated. And the second hope is that because it has got government backing, you can at least sell the security receipts and get out of it. So do you think, banks, corporate lenders, both public and private, in 22 will be able to lessen their provisioning because of this?
No, one is about the provisioning part or accounting part. Let us keep it aside for the moment. But the idea to guarantee the security receipts and up to what extent it will be guaranteed, that is not yet known. But any movement of bad assets out of the bank's books as per the RBI rules, it has to be a true sale. And because the proposal was, and I'm presuming that it will be the same, that all the assets which have 100% provision, initially these assets will be moved. So net book value is zero. Banks have already provided 100%, but when they move, 15% will come by way of cash, and the 85% will be security receipt, and a certain percent of that would be some sort of a contingent liability, a minimum guarantee. It's not that the entire 85% will be guaranteed by the government. And when the in a transparent manner, the price is discovered for the security receipts, the upside or the downside that will go to the selling institution, but with the minimum guarantee. So if suppose the asset is transferred at 100 crore and 85 crore is the SR, and government say guarantees, I don't know, 10%, 15%, or say 20%, then government's contingent liability is 16 crore. And it will arise only if that asset cannot be sold for, say, 100 crore. And if it is sold for more, then obviously there will be no liability on the government. So that is how it is proposed to be structured.
Okay.
The consolidation will definitely help in the decision making.
Okay.
And the buyer, from the buyer's perspective, they will have more surety about a faster decision.
Okay.
So it can result into a better recovery.
Faster.
As far as the resolution part is concerned, there are two mechanisms. One is outside the NCLT framework, and second would be the NCLT framework.
Okay.
So that part, if it is in the NCLT framework, how do we cut down the delays? That can happen only when the NCLT infrastructure gets augmented. Otherwise, that part, this ARC does not resolve.
Okay, I take your point, sir. So it's a cautious optimism. Let us hope that the NCLT and the pre-PAX rule is also in place. Anyway, the budget even spoke about that. Mr. Mundra, I saw your interesting article in Business Standard on privatization of banks. I hope I can get something on that from you on the show. How do you think? You think the government should go with the smaller banks first and not try the big ones like PNB and BOB?
So, okay. But Lata, sorry, you are not asking me, but I think we are moving from ARC issue
to privatization, yes.
To privatization. But
right.
Nonetheless, I would like to make a point that how you do the accounting, how the SRs are done and all that is all fine. Actually, what would be the spirit behind this ARC? I think the central idea should be reconstruction and not liquidation and sell off.
Okay.
And if reconstruction has to be done, I think there will be issues around, there will be need of additional funding, and whether, because large cases in any case are already out in one dispensation or others. So you are talking about the medium and small enterprises.
Yes.
If they have to be reconstructed, whether you are prepared to engage with the promoters or you want to keep them out. I think those are the larger issue. But sorry, unsolicited comments. Which we have not asked for. No. As far as privatization is concerned, I think I was quite clear in that article also, if you would have seen it, that and incidentally, my article coincided with a news item from Niti Aayog on the same day, which also echoed the same thing, that these 5 consolidated banks in any case are out of it. So quite clearly, I think we have come down to the privatization of 2 small banks, and that is the right thing to do. But as I mentioned there, by moving with 2 banks, you can't hope to address either the whole governance issue which we talking about, or the efficiency issue, or even the capital. But I think it is a kind of a very strong indication, and at the same time, it gives you a lot of real life learning that when you move on this path, what could be the problems which can come, what needs to be, what you need to do the course correction and all that. But as I said just quickly, even in doing that, see, there will be an investor expectation on one side, whether they want the government to be there partly or they want government to be completely out, the valuation, the due diligence. But if you have to save the liability franchise of these institutions,
Okay.
then I think continuing presence of government is important. So
Okay.
I think those are some of the things
Got that.
which I would.
So actually, you're right. I should have kept privatization for another show altogether because we are running out of time.
The larger
Mr.
issue.
Yeah. Mr. Sinha, your final thoughts on this bad bank or on the DFI, if you want to add, which the Reserve Bank has to keep on the table.
Well, DFI, I think we have already discussed both the liability side and corporate
The
governance.
ARC?
As far as bad bank is concerned, yes, it has to be once in a very long while kind of setup. And maybe this is the time to go for it. But equally important is that while this handles only the stock, what about the flows? And that is we have also to take steps so that the fresh generation of NPAs is not out of control. And that is where the question of reforms comes in. There has to be an important and equal attention to the question of reforms so that the flow of NPAs can be contained.
Okay. So we have lived with the bad loan problem for at least 4-5 years now, and one hopes, therefore, that government, banking sector, bureaucracy, everyone is alive to not allowing the cycle to be recreated again. Thank you very much, Mr. Rajneesh Kumar, Mr. Anand Sinha, and Mr. Mundra for joining us.